Welcome back to the Investor Professor Podcast. This is Dr. Ryan Peckham. This is episode 25. And on today's episode, we're going to talk about gratitude. As we have Thanksgiving coming up, we're going to discuss how gratitude can help set the stage for your future goals. We're going to keep the discussion going on financial statements and discuss the income statement. And then we're going to revisit dividends. I've had a lot of questions about dividends, and so I wanted to discuss this a little bit different way today. So I hope you'll join us. I appreciate you being here. Get your mind right, and let's get to work. All right, so thank you for joining me again. It'll be weird to see how many listeners we get over the holidays. Obviously, I haven't done this over the holidays yet. So people's lives get busier. We all start having a ton of things to do. And so we'll see what happens with that. But interesting week in the market this week. A couple highlights I wanted to discuss. One of them was RIVN, the automaker that everybody thinks is going to be the next Tesla. This past week, they recently went public at $100 a share or so, and then it ramped way up to $172. And then this past week, it went from, on Tuesday, it was $175. I guess they hit about a high about $175, and then that was on Tuesday. And then Wednesday, Thursday, Friday, it just got clocked, and it's all the way down to $128. So their market cap, remember, market cap is the total value of the company. If you're going to write a check for it, that's what you'd have to pay. Their market cap is currently $113 billion. So to put that into perspective, it's more than Ford, it's more than GM, and not really sure what's going on here. My thought process is there is a lot of people who are sad that they never invested in Tesla. And so they're looking for okay, how do I correct this trade? Let me find the next one that's going to be like Tesla. But you have to understand, Rivian's only produced 100 vehicles. I'm not even sure they've sold any. And so the fact that they're, just skyrocketing like this, I mean, there's going to be, my assumption is there's going to be a lot of people that are going to get hurt. It's called the stock market for a reason. So it's a market. There has to be buyers and sellers. So, there are definitely some people who bought it at $174 a share that are sitting there going, oh, great. What am I going to do with this now? And so, we kind of live under the assumption that we're always going to get a good price and it's going to keep going up. But this would be a perfect example of why you'd want to use a stop on a trade. If you had bought this, you would have wanted to put something in place that would have sold you out. And I think about it too, Rivian, you're sitting there in your car, maybe you're working out, whatever you're doing. I mean, tell me who the CEO of Tesla is, right? Everybody knows who Elon Musk is. There's probably not very many people on the planet who don't. Tell me who the CEO of RIVN is. I mean, I'll keep waiting. I mean, I guess I could find some Jeopardy music. I can't name him. I can't name the person. I have no idea. And so, this fear of missing out sometimes can get you into trouble. Not all of these companies are created equal. And so you got to be very, very careful with that. Just because you might have missed Tesla under $100 doesn't mean the next one's going to be just like them. I thought one of the most interesting stats I can give you on Tesla is that they have not spent any money on marketing. And that is incredible when you think of car companies, right? Think about the last Super Bowl you watched, right? Tons of car commercials, GM, Ford, all these companies, Toyota, they're spending tons and tons and tons of money on commercials. And somewhere there's some advertising executives at GM, Ford, and Toyota. They're spending billions of dollars a year, and they're getting crushed by Elon, who's basically just using social media and no marketing money. Like, how frustrating are those people? I mean, it's got to just be incredibly frustrating to them. But, it's different. And so that's kind of my short little speech on this. I mean, I don't know if RIVN's going to work out or not, but it's getting a little frothy here on some of these EV names, these electric vehicle names. And so I look at it and I look at what Ford's doing and how they're executing. I mean, don't sleep on Ford. They're looking really, really good, and the electric F-150 is going to be pretty phenomenal. And at $19 a share, I'm starting to wonder how is Ford that, how is Ford valued that low? So, anyways, that's my 2 cents. But we'll see. Also, just kind of funny here. I told you I was starting to track things better, figuring out my listeners, looking where my audience is growing, all that kind of stuff. Spotify has a really good, really pretty powerful system on this that I just discovered. But one of the funniest things about it is it kind of shows you what the artist, like the music that your followers are listening to. And nothing has ever made me feel as old as this, because there's like 3 of them. It always gives you like the top 5. 3 of them, I got no clue who they are. And no, I'm not going to say them because it'll just make me seem older, but it's just funny. So now I got to go look up some of these and try to reverse my age by 20 years, 15 years. So this past week, my top 2 countries that streamed this podcast were the United States and South Africa. So how does that go? I have no idea, but pretty interesting nonetheless. So I appreciate y'all listening. I had a lot of good feedback. I was worried about last week's episode that it was going to be too detailed, but I had a lot of good feedback from people, and I really appreciate your feedback because, like I said last week, I'm just tired of really kind of doing surface level type stuff, and I want to do stuff that's a little bit more detailed and a little bit more challenging. And so I know some of y'all take notes while listening to this and you re-listen, and I appreciate it. I think about that when I'm coming up with episode topics. And so I just want you to know that I do take that into consideration and try to give you, your time's worth here. And so I do appreciate that. Also this week, as we celebrate Thanksgiving here in America, I wanted to let you know, I guess a warning, December, I'm going to start hammering you the entire month on starting to set your goals, to really put some time in place. I'll be much more diligent about it in the next couple episodes. But this week, one of your assignments is to write down 10 things that you're thankful for. 10 things that have happened this year that you're very, very thankful for. And when you start looking at the things that have happened in your life that you're thankful for, it's easier for you to set goals because you realize that you have things in your life that are already going well, right? So kind of this start with gratitude. And if you can start working on that list, it'll make it easier when you start to think about the goals that you want to have for the next year. So whether they're big or they're small, start thinking about the things that you have in your life that you're already grateful for, thankful for, and you'll be surprised. I mean, sometimes these are easy to come up with, and sometimes they're not. One of the things I struggle with is contentment, right? Wanting the things that we already have and not always striving for something else. I'm constantly going after more. So, think about the things that you're thankful for, that you're excited about, and that'll be the anchor for the goals that you set here in the near future. So spend some time on that. This is a good week. Normally everybody has a little bit of time off. You can put your phone down, grab a notepad, find some quiet space, and just kind of think about and reflect on some things that you're thankful for. And that will kind of be step 1 on your goal setting for 2022. Okay, so we're going to spend the rest of the time today discussing the income statement and dividends. And last week we did the balance sheet. I'm going to give you a high level on the income statement, but enough that you can be dangerous with it, which is kind of the point here. So I'm currently looking at Apple's income statement. It doesn't really matter which one you look at as far as, company. I'm just using them as an example because I had them up. But again, I'm looking at the one on finance.yahoo.com. And when you look at the income statement, you have to understand a couple things. So the income statement is going to tell you how much the company made in sales. And so you'll see, it'll say total revenue, which revenue is a fancy business term for sales, right? So when you hear the word revenue in your mind, you got to say, okay, that's sales. How much in sales did they have? And so it'll tell you their total revenue, and then it'll give you their cost of revenue, which is what was their basically cost of goods sold. How much did it cost them to make those sales? And then it'll give you their gross profit. So this is kind of, your first stop of looking at this going, okay, when you look over the years, is their revenue increasing, right? You want to see those sales numbers increasing. Right? You want to see the revenue number increasing. Are they increasing their sales? That is definitely a positive thing that you want to look out for. That cost of revenue, depending on the kind of company it is, could be very close. So for example, like right now I said I'm looking at Apple, but if you go look at Amazon or Walmart, they're going to have their cost of goods sold are going to be much closer to the total revenue number, because they're doing it off volume, right? So, and that's when you start looking at what's their gross margin, what is their profitability on these goods. So if I'm looking at Apple here and I see that they sold the trailing 12 month number is the one I'm looking at, and it was $365 billion. Is that good? I don't know. Actually, it's really good. Spoiler alert, that's really good. $365 billion on a cost of revenue of $212 billion. So you have gross profit of $152 billion, which gives us a margin of 41.6%. So I take $152 billion divided by that 365, 41.6%. That is a very, very healthy profit margin, especially on a company that big. So under the gross profit, you're going to see operating expenses. And the first thing you're going to see under operating expenses is selling, general, and administrative expenses, which is basically how much are they paying all their employees and the people that work for the company, how much is that costing them? So this is one of those numbers that you want to see it probably rise as sales rise. They're going to have to hire more people. Their expenses here are going to go up on administrative expenses. But one of the things I want to caution you on is that there's a couple ways for a company to appear to make money, right? Like, so you have the healthy one that I just discussed, which is you want to see their sales growing. If their sales are growing, that means their products are in demand. There's more people buying their product. Fabulous. But what happens if you see their sales dropping but their earnings per share are still growing? So the income statement is where you're going to find earnings per share. And so one of the easiest ways for a company to appear more profitable than they really are is to let people go, right? If we fire a bunch of people, all of a sudden we become very profitable, or more profitable, not very profitable, but we become more profitable. But the problem is we can only do that for so long. We can't just let everybody go, right? So some companies can kind of appear to be doing better than they really are because they're letting people go and their earnings per share can rise. And so when you're looking at companies that report quarterly earnings, sometimes you'll hear if you're listening to some of the analyst reports, you'll hear that somebody beat on the top line and the bottom line. So the top line is the sales number. It's the revenue number. Did they beat their revenue number? The bottom line is the earnings per share number. So did they beat their earnings per share? So if they have a top line beat and a bottom line beat, that is very good. Sometimes you'll have them have a top line miss and a bottom line beat, and that means that their sales were lower, but somewhere they found a way to cut costs and to still beat their earnings per share. So this is the financial statement where you can figure that out, is going into the income statement and figuring out, okay, have they been able to grow their sales? How's their profit margin? Are their costs of goods sold getting more expensive? Is their margin starting to shrink? Is this product, even though they're selling it, it's becoming more expensive to make, and therefore they're making less money off of it? Are they, adding to their administrative expenses? Are they cutting their administrative expenses? So this kind of gives you a nice view into the business as far as what sales are doing, what's kind of the driver for the company. And this trickles down to that earnings per share number. Now, one of the questions that many new investors have is about the share count. And every company has a different share count, right? There's no, it's not that everybody starts with 1 million shares. No, every company has a different share count. So that's why looking at just the price of the stock is a terrible way to try to determine whether you should invest in the company or not, because every company has a different share count. So paying attention to that earnings per share number is also key. Are they able to grow the earnings per share? Because if you look at the earnings per share growth and you can kind of extrapolate that out 10 years, you can figure out what the price of the stock is going to be close to. You can make an estimation based on the current PE ratio of the stock. So this is when I start having a lot of fun. I don't know about you, but this is when I start to get excited about this because I can do a pretty good guesstimation. So if you take the earnings per share times the PE ratio, you get the price of the stock, right? So if I know that a company's growing their earnings at 10 to 15% a year, I can then figure out what the earnings per share should be in 10 years. I can times that by the PE ratio and estimate what the stock value is going to be 5 to 10 years from now, right? The longer you go out, the more inaccurate that's going to be. Obviously, interest rates, things like that are going to have, they're going to have an impact on that. But for the most part, it allows you to be able to do that. So the income statement is a great tool to be able to kind of look behind the, open the hood on the company and find out, are they growing their sales? Are their expenses in check? All of the things that we just talked about, but it is important to familiarize yourself with that so you can start, having that vocabulary, that vernacular of, are they beating their earnings, top line, bottom line? How are they doing that? This allows you to be able to do it. So go check out some companies that you've been following, and you can start to look and see what's going on there. So I touched on this in episode 17, which was DRIP, Dividend Reinvestment Plans, but I've gotten a pretty good amount of questions on dividends and looking for companies that pay dividends. And so I wanted to spend a little bit more time deep diving into this a little bit more to kind of caution you on how to find good dividend payers and kind of give you just a little bit of more of a breakdown on this. So some of my biggest mistakes, if you will, have come from finding what I thought was going to be a good dividend stock, and then all of a sudden it turned into a nightmare. And so I wanted to teach you what those lessons I learned from that were. So when you look at, and this kind of flows into that income statement or the financials that we've been discussing here. So when you look at the financials and you look at that income statement, you will see what the earnings per share are of the company. So when you look at that earnings per share number, you have to think to yourself, what can a company do with those earnings per share? Right? What are the company's options? Well, the companies can keep the money and reinvest it back into the business, or they can pay it out to shareholders. And they can pay it out to shareholders in a couple different ways. They can do dividends, or they can buy back their own shares. And so we're going to have a little bit of a conversation on this. But when you look at that earnings per share number, some companies, the question I get asked more than any is, why do some companies pay a dividend and why do others not? Well, normally when you see a smaller, like up and coming company or somebody who's growing really fast, they need to reinvest that money into the business so that they can keep expanding and growing. So for example, Amazon is one that comes up a lot. Well, Amazon, they use the money that they're making. They're doing more distribution centers. They're investing into, right now they're going from 2-day delivery to 1-day delivery, I guess, to maybe 1 hour delivery, or pretty soon they're going to be able to send us the stuff before we even know we want it. I don't know. Right. But they're reinvesting that money back into the business. And they think that for their investors, that's a better investment for the investors than sending them a dividend or buying back shares. Okay. So that also happens with somebody like Google, who's investing a ton of money into YouTube and different things that they're doing, different new projects. Same with Facebook. Right. So historically, tech companies have not been big dividend payers because it costs a lot of money for them to invest in research and development and new technology. And, it's funny, the NASDAQ, if you were to look at the NASDAQ as a, look at the stocks in the NASDAQ, they used to say that the NASDAQ was for tech companies. But now everybody's a tech company, basically, right? I mean, every single company is using technology. So we'll have to see where that goes. But so when a company has these earnings, they can either reinvest it back into the business, or they can pay it out to you in the form of a dividend or a buyback. And so what happens, though, and this is a mistake that I made, what happens if a company makes $3 a share in earnings and they pay out $2 a share? Right? So they're making $3 a share and they pay out $2 a share. Well, the problem with that is if a company is paying out too much in dividends, then they don't have anything to invest back into the business. And I am telling you, put this in your mind, because this is where some of my biggest mistakes have come from when I was younger doing investing. I would look at a company, I'd say, oh man, they have a great dividend. I'm going to invest in that company. They have a great dividend, but I didn't realize that they were paying so much of their earnings out in the form of a dividend that they had nothing left to invest back into their business. That is a problem. Long term, that is a problem. So you have to be willing to do a little bit more homework, go a little bit deeper, to make sure that the companies that you're investing in are able to invest back into the business, do a dividend, all that. I keep bringing up Apple, one of the best companies in the world, but not only do they invest back into their business, they do a dividend and they do a buyback. I mean, that's pretty rare. I mean, that is very, very rare. And so, when you're looking at this, though, one of the companies that I want to discuss is you hear this saying like Dividend Aristocrats, which are companies that have a history of not only paying a dividend, but have a history of increasing their dividend. And so some of those are going to be, Caterpillar. It's going to be AbbVie, which is a company we discussed a couple weeks ago, the maker of Botox. AbbVie has grown their dividend 49 years in a row, and they currently pay 4.5%. They grow their earnings, and they have a healthy, they're doing it in a healthy way. You have 3M, which is the maker of the Post-it note, is one of their most famous products. McDonald's is on this list, I believe. You have Emerson Electric. You have just a number of well-known companies. Johnson & Johnson has increased theirs 59 years in a row. And so, you can do a quick internet search of companies that have increased their dividend, but you just want to be careful where this happens. Where I told you I got in trouble with this specifically was with oil and gas companies. And the reason is because all of a sudden they're paying this dividend, which is fine. And then oil goes from $80 a barrel to $40 a barrel. And we're not making near as much money. And we have this big dividend to take care of. Not only that, the oil and gas business is expensive. A lot of times they have a lot of debt. And so you're trying to service that debt, plus you're trying to pay a dividend. And if oil prices stay low for a long period of time, all of a sudden you have some major, major issues. So you have to be careful with this. So one other thing you can think about is that what is their dividend payout ratio to their earnings per share, right? So if they're paying $3 a share and their dividend's 150, that would be 50%, right? And so there are some industries that are going to pay a little bit higher than that, companies that have recurring revenue. So, if you look at, let me think, telecommunications companies like AT&T, Verizon, who, people pay their cell phone bill every single month. I mean, most people will pay their cell phone bill before they'll eat, right? They're going to have a little bit higher dividend payout ratio because they know that they're going to get that recurring revenue. But it is something that you want to be cautious of when you look at, what's their earnings per share, what's the dividend, are they above a 50% payout ratio? That might be a place where you want to consider it. I would definitely look long and hard before making an investment in something that has a much higher dividend payout ratio. Also looking at the debt that they're holding. But sometimes, many investors, they just look and go, hey, this company's paying 8%, fabulous. I'm going to get in on that. And, you also have to look at their competitors in their same business, right? Their same sector. If they're paying 8% and their competitors are all paying 4%, why are they that much above, right? Are they trying to attract investors just off the dividend, but it's going to be something that's not sustainable? Those are the things that you have to consider when looking at this. Because if you go back and listen again to episode 17 on that dividend reinvestment plan, I mean, if you're going to do some dividend-based investing, you want it to be in companies that are going to be able to sustain it and also be able to invest back in their business so that they can grow their earnings, increase that dividend, and move on down. So one of the ones I wanted to highlight for you this week was Lockheed Martin. So Lockheed Martin is a defense company. Their symbol is LMT. And for the last 10 years, as far as a company that I've invested in personally, they've been one of the best as far as dividends are concerned. They pay right now $11.20 a share per year. So let me see what that is a quarter. So $11.20, that's $2.80 a share per quarter per share. And I know that 10 years ago, they were paying $1 a share. So over the past 10 years, they've grown their dividend 15% a year, which is beyond tremendous. So, looking for these companies that have the ability to do that is going to be important for your portfolios, right? And so when I look at their earnings per share for the last year, they made $24.40 a share earnings per share, and they paid out, $2 or $11 of that, right? $11.20 of that is going out. So that's still under 50% of what their earnings per share are, even though that's a tremendously high dividend. And being a defense company, right? The nation's always going to protect itself. We're always going to need defense companies. Lockheed Martin is definitely one to go do some research on, do your own research, and looking to see if that might be one that's for you. It's definitely been down over the past year. It hasn't been a good year for Lockheed Martin and the defense companies. So could be one that you could go and look at. So forgot to say it in the beginning, but this podcast is for entertainment purposes only. Please make sure you do your own research. Don't buy or sell anything based solely on what you hear. Consult your financial advisor. I'm not your financial advisor. And past performance is not indicative of future results. I hope you all have a wonderful Thanksgiving. Don't forget your assignment. Make sure you write down some things that you're grateful for. It'll set you up for being able to set your goals for 2022. It'll kind of put a baseline in there when we think of the things that we're thankful for. I appreciate your time. I appreciate you sharing this podcast. We've been growing our social media exposure pretty well. Been growing the listener count faster than I expected. And I know that's because of y'all, because you're referring it to your friends and family. And I do thank you very much. So I hope you have a wonderful Thanksgiving. Have a productive week, and I'll see you next time.